Would you rather have an 8% average annual return or a 6% average annual return? One of the first questions we get from folks who are thinking about working with us is, what is your average annual return? And I always hate to tell you, but it doesn't really matter. And I'll show you why here today. On your screen, you have two different folks, Hans and Franz. Both are retiring with a $1 million portfolio. Both are withdrawing $50,000 a year. And if you look at your return average or average annual return on the bottom of your screen, Hans is making 8%, Franz is making 6%. Hans is going to be a lot more popular at the cocktail party than Franz. He's making more money, right? Not the case. Look at the end of year 10, that end value. Even though Hans has a higher average annual return than Franz, Franz has got more money at the end of 10 years. And how can this be? Well, when you're taking regular withdrawals from an investment account, the percentage return that you receive is much, much less important than when those returns occur. We call this sequence of return risk. Hans is starting off his retirement with a 13% loss, a 20% loss. So even when he has that great 45% up year in year 8, the 45% increase is occurring on such a reduced account value that it's not saving his bacon. If you compare that to Franz, who's got what we would consider probably a pretty conservative portfolio, or at least more conservative than Hans, he's making high single-digit, low double-digit returns, but he's not losing a lot of money in bad years. And because of that, when he has those 5, 6, 7% increase years, they're occurring on a relatively larger asset base or account value. And that's why he's ending up with a larger end value at year 10. So I think Hans and Franz are really instructive. It's one of the reasons why we are big proponents of not keeping everything in stocks, especially when you are needing to use your money to fund your lifestyle. When we talk with folks and when we're setting up investment portfolios, we'll oftentimes calculate out what your annual spending requirement is. And then we like to make sure that you've got at least 5 years of annual withdrawals in bonds or in cash or a combination of the two. And the reason we do that is if you are very unlucky and you retired at the top of the market in 2006 or 2007, if you could last for about 5 years without touching your stock investments, you would have been okay. That great global financial crisis, you would have made it through just fine. Your stocks would have had time to recover. And then at the end of that 5 years, you could sell some of those stocks now that they've recovered and replenish your bond holdings. If you have any questions on this, please feel free to let us know. But this is a little snippet in how we like to construct investments, and I hope you found it useful.